Welcome back to the second half of the Future Show. We're less than 60 minutes away from the cash open for stocks on Wall Street. We've got Scott Bauer joining us. He's the CEO of Prosper Trading Academy. He's here to help us take a look at financial markets. And, well, Scott, good Tuesday morning to you. I hope you enjoyed the holiday weekend. And thank you. And I wanted to begin with Biden inviting Fed Chair Jerome Powell in a rare circumstance event to come to the White House and basically talk about inflation and how we can, well, what we have in terms of tools to drive it lower.
It's definitely a big question mark. I think we're at a point where Biden, the administration, is showing a lot of frustration, not necessarily with Powell, but just with the whole situation here. And, maybe it's coincidental that, he was just reappointed and that started last week. But I think that we're at a point, Ben, that it almost seems like it's going to be throwing spaghetti at the wall and see what sticks sort of thing. I don't think this is a positive look at whatsoever.
Yeah, it's funny because the Fed was pretty clear in terms of raising rates. Their ability to came from a strong economy. But I think things have heated up to the point where they've expressed some concerns themselves. Take a quick look. We were just showing the 30-year in terms of the run-up we've seen to 3.25%, how we've come off the last few days from that spike high. Now I've got the 30-year on the left, the 10-year in the middle, the 5-year on the right. If we could just pull this chart, because I want to show, again, how shorter all the way into the longer dated, we've been seeing this move up. Scott, we talked about at the top of the show. I mean, a big part of that is prices at the pump. I mean, energy prices, crude overnight back to 120.
It's brutal. And the news coming out overnight with the Eurozone and Russia obviously just putting even more pressure on the space, and it's not going away anytime soon. So again, I think this meeting is for the two of them and whomever else might be there to really lay out any possibility whatsoever. And quite frankly, it does not exude a lot of confidence, in my opinion. Scott,
have you heard anything in terms of Putin's potential backlash on this one, kind of rattling the cage, it seems like, under this instance?
No, other than it seems like their exports to India into China are going to continue, probably even increase. And from what I saw, they're exporting at $90 a barrel to India and China. So they're happy doing that. Everything that I have read coming out of Russia, it costs them somewhere between $65 and $70 a barrel to produce. So, they're still making a lot of money. And, I don't know if the backlash just means that they're going to export even more there, or what that is, but it's a pretty dire situation.
It is, and there's geopolitical aside from Russia, Ukraine, and Europe's response too. I mean, geopolitical ease of tensions, I guess, in the Middle East. I mean, if things were to start to escalate there by any means, or if there were to be some issues that were raised there, obviously we'd be talking about a look at 130 quickly. I just wanted to point out, here's crude oil, the WTI, but Scott, it's also, as we mentioned, RBOB gasoline prices again at $4 here right now. And in many ways, RBOB's been leading the way to the upside. We were wondering if crude would participate. It has, clearly. Here's natural gas recently to $9.44. And Scott, I kind of want to shift back because a big part of this, one could argue, has been the dollars coming off recently from 105 back down to 102. And whether you tie that back to the ECB and some of the comments recently from Lagarde in terms of, turning the corner, I think she said they were, as far as moving away from negative rates to positive. It seems like they're going to kind of get on board in terms of this more, aggressive stance towards inflation. I mean, overnight, we started off the show looking at their year-over-year numbers here in terms of CPI. I mean, significantly higher, 8%, I think it was, record levels, basically. You can understand why.
Oh, yeah, 8.1% from 7.4% last month. They absolutely have to start catching up, which, that'll be okay for the dollar here. They absolutely have to start catching up. Record high inflation, big jump in German consumer prices, which, they feel that's going to flow through to the rest of the Eurozone. So it's going to be a battle here, and I think that is going to underpin the dollar, the weakness that we saw over the last week or two, as you said, from 105 down to 102 area here. That should put a little bit of, tailwinds under the dollar.
Under the commodities, you mean, with the dollar coming off, you're saying?
Yes.
Okay.
Exactly.
Just wanted to make sure I was hearing you correctly there.
Yes.
And the dollar, again, if we could just pull this chart from 105 down to 102, a significant move in itself. I mean, this had been a well-defined trend environment to the upside. I just want to remind everybody, when you're talking about the U.S. dollar, and this is the /DX, the futures contract, you got to remember that, again, the reason I bring up the euro currency, Scott, it's the bulk of it, 75% of, so that inverse correlation at play. And then also I want to remind everybody, if you don't have access to this futures contract /DX, just type in $DXY and you'll get a look at the index. So you'll see the exact same thing. Again, the dollar coming off recent highs, the euro's firmed up off recent lows. Talk to us about rates here, Scott, and the treasuries. I mean, you've got a Fed that, well, in many ways, we're kind of in a wait-and-see mode now until we get to June as far as getting something definitive. It looks like it's kind of been penciled in 50-50 at least. Waller, I mentioned at the top of the show, is saying, look, continue to bring 50 on until we get inflation to that 2% level. But talk to us about rates right now. Do we kind of pause, catch our breath, sort of look at where we are at this point and sort of gauge and balance the impact that higher rates are going to have on the economy, because that's a big factor. I mean, if we continue to see strength there, then in theory, rates could continue to go higher if the inflation factor is still present. But if all of a sudden the Fed gets its way and we start to kind of slow some of that growth, then maybe rates could have topped out, I guess.
Well, it's really that good news, bad news scenario. Is good news bad news, and is bad news good news in terms of the economy? And I think, Ben, what you just said about maybe stalling a little bit here, that's probably what we do for this week. And then the closer and closer we get to the Fed meeting, I think we're going to start seeing some pressure, and I think we'll start to see rates back on the rise again, unfortunately. That's my expectation. Certainly Waller was pounding the table here to just keep going and keep going and keep going. And you know, what we saw last week, I think, was a nice little relief, seeing the 10-year back down around 270 or so, you know, out from or down from its high of around 320. But I think that's going to be real short-lived.
Scott, when you say on the rise again, do you mean back to those upper levels and kind of form a bit of a range, or do you see further extension up and through 3.25 for the 30-year? And what was it, 3.16, I think, 3.15-ish for the 10-year?
Yeah, I think up towards the top of the range, Ben, and I think that range now, the 270 to 320 that we've seen over the last few weeks or last month or so, I think that's going to start moving upwards. I think that's going to start escalating.
Let me just pull the chart here real quick. We can take a look. Here it is, 270 to 320 roughly, and you can see, again, a pretty well-defined range here. Let's talk a little bit about some of the other topics to keep an eye on here, focal points this week, Scott. No numbers here at the bottom of the hour for us to break down, but a little bit later on we'll get some housing numbers. Does seem like we've seen some cracks in the dam there with rates on the rise and 30-year mortgages up and through 5%. Talk to us about, in addition to that, I mean, a lot of focus here on the manufacturing data this week. Ultimately, the jobs reports here, though, labor conditions a little bit later on as we head into Wednesday, Thursday, and Friday.
It's still really surprising to me, and everything you just mentioned is very important, but it's still really surprising to me, Ben, to see how resilient the consumer has been in the face of all of these rising pressures, rising prices, inflation. And the data that we got at the end of last week still kind of, you know, really said that, you know, the consumer is really still out there. And I think that has to change. I mean, it only makes sense that at some point here, the consumer is, you know, the data anyway, is going to start reflecting the consumer pulling back. I think we have already seen that. The data is always late, but, you know, you and I have talked about this. I see it with my friends, acquaintances, relatives. People are making choices. People are pulling back in certain places. So to me, that's the big dam that has not cracked yet or has not burst yet, that we really have to watch out for. Like you said, we've seen it in housing here with slowdowns, and many of the housing stocks have just gotten really hammered because of that, because of rates. But to me, it's really focused on the consumer, Ben. And, you know, I don't know whether we're weeks away, months away from seeing some reports that really reflect that, but that to me is the biggest concern.
Scott, final thought. We'll let you get out of here. Bitcoin, speaking of a dam, it kind of held ultimately the water or the flows back around that 29, 30,000 level. And we're seeing a little bit of a lift here this morning, enjoying a bit of a bid recently off those lower extremes. Have we moved away from that level, or are we still under pressure here as we remain dangerously close to recent lows or most recent lows that we've seen down below 30,000?
No, I think we're still under pressure.
Okay.
I think if we start to see the equity market sell off again, and I know we're lower this morning, but I'm not just talking about this morning. If we see the equity market maybe start tailing off again, I would expect Bitcoin to follow it.
All right. Seemed like it was lagging a little bit over the last few days. The indices rallied off those New Year low prints Friday 2 weeks ago. Something to keep an eye on here. Appreciate you joining here. Scott Bauer, the CEO of Prosper Trading Academy. Thanks to you, Scott. Enjoy your week. And, well,